What are your expectations for this jobs report? And also, we've talked about layoffs throughout the show and just, in recent weeks, tech layoffs over 30,000. And we've heard some big headline numbers from a UPS, 12,000, Citi, 20,000. When do these layoffs, when do they start to show up in these reports?
Yeah, I don't think we're going to see evidence of that very obviously in this January reading. It could be an interesting one though. We're expecting actually stronger payrolls. We've got 240, so it's a pretty strong reading, a strong increase in employment in January. But some of the details could still be interesting. We're expecting the unemployment rate actually to rise to 3.9%. Could even see maybe some upside risk there. So in some of the details of what is still very strong on the surface employment, you still might see those signs of the labor market is weakening.
It's so funny you just said that. You said on the surface, strong job numbers. I want to talk to you about the initial job numbers, and then later we've had a lot of revisions. In fact, for many months over the last year, we've seen revisions. Double Line Capital's Jeff Gundlach, he was here on CNBC the day of the Fed decision, and he talked about that. I want you to listen to this. I want to get your reaction.
And there's also data that never gets reported to the extent it should be, which is unemployment data that's reported on a state level. The states do this too. And they have 51 states. I think they have D.C. in there as if it's its own state. And something like 85 or more % of those 51 state reports have rising unemployment over the last 6 months. So there's a strange mathematical inconsistency that the unemployment rate stays at 3.7 on the National House Establishment Survey, but over 85% of states report that unemployment is rising over the past 6 months. It almost doesn't seem possible.
So I want to get your take. What do you think about what he's calling that strange mathematical inconsistency?
Yeah, it is very interesting. We've looked in the state level data also. Technically, they do come from two different surveys. But yeah, we have seen this rising trend, maybe more clearly in some of the state level data. There's been a lot of focus on this, so-called SOM rule, when the unemployment rate, the 3-month average of the unemployment rate rises 0.5% from its low over the last year. In the past, that has always signaled a recession. Nationally, we were getting close to that maybe a couple months ago, and it has already triggered in about 19 states. So it is something to watch for, and we might be getting close to triggering that nationally.
So, Veronica, I don't know if you're a football fan or maybe a Taylor Swift fan. Either way, the Super Bowl is coming up. So we have the possibility of a strike in Vegas, also strikes in a number of other areas. How does that impact the labor market going forward? And again, this data. And then if we have those strikes, what do you think it means to the Fed?
Yeah, it has been a very interesting labor market over the last year. We've definitely seen some loosening. We've definitely seen, hiring slow down, quit rates that have dropped. But what we haven't seen yet are these big layoffs. And anecdotally, maybe we're hearing about that. But there is still some tightness to some parts of the labor market. We've seen strike activity increasing over the last year. Of course, auto workers was a big one, and that does result in wage pressures. And we've seen that even in the latest ECI report, for employment cost index for Q4. We've seen those, unionized, workers getting large wage increases. Right. So it is worrying, for the longer term trend of inflation if we're still running, 4 to 5% wage growth.
The Fed's dual mandate includes maximum employment. So we pay up so much attention to these inflation reports, CPI and PCE. Should we be paying more attention to these jobs reports, specifically those downward revisions?
Yeah, it is definitely something to watch. Of course, we're going to get the downward, benchmark revisions for the full year of 2023 today. And the trend already has been slowing. But as long as on the surface, the labor market is still very healthy, we're still adding jobs, unemployment rate, even if it picks up today, it's still very low. That is allowing the Fed, time to be patient when it's considering rate cuts. It's allowing the Fed to, be careful cutting rates. But as soon as, the employment data does turn, I would expect that's a more dovish Fed.